There are 180 currencies in the world today. 180 different ways to buy bread. Japan uses the yen. Europe shares the euro. The United States prints dollars. And somewhere in the middle of the Pacific, the island nation of Kiribati uses the Australian dollar because printing their own seemed like too much trouble. This seems inefficient, wasteful, even if money is just a tool for exchange. Why do we need 180 versions of the same tool? Why not one global currency? One price for everything, everywhere, no conversion fees, no exchange rate chaos. It sounds logical, reasonable, the kind of idea that gets proposed at dinner parties by people who had 2 glasses of wine and suddenly think they solved economics. But here's the thing. Every country that has its own currency chose to keep it, even when given the chance to share, even when it would have been easier not to. And the countries that did give up their currencies, some of them are still paying the price. So, this isn't a story about money. It's a story about control. About who gets to decide what your work is worth, what your country owes, and whether you can survive the next crisis. Because it turns out, the answer to why every country invented its own money is the same answer to a much darker question. What happens when you coup? Let's start with the obvious appeal of one global currency. Imagine you're traveling from New York to London to Tokyo. Right now, you lose money 3 times. Once converting dollars to pounds, once converting pounds to yen, and once more when you come home. Banks take a cut every time. According to the World Bank, currency exchange fees cost the global economy roughly $200 billion a year. That's real money evaporating into spreads and commissions. Add to that the unpredictability. In 1997, the Thai baht collapsed overnight. People who went to bed middle class woke up poor. In 2015, the Swiss National Bank stopped pegging the franc to the euro without warning. Mortgages in Eastern Europe, taken out in francs, suddenly doubled in cost. Lives were ruined by a decision made in a boardroom in Zurich. So yes, one currency sounds clean, stable, fair. But here's what that argument misses. Money isn't just a tool. It's a weapon. And every country on earth knows this. Let's go back, way back. Before currencies, before coins, before anyone thought to print paper and call it valuable. Trade existed, but it was slow and awkward. You had sheep, I had grain. If I didn't need sheep, we didn't trade. This is called the double coincidence of wants, and it's why barter economies never scaled beyond small villages. So communities invented commodity money. Shells, salt, cattle, things with inherent value that everyone agreed were worth something. But commodity money had problems too. Cows die. Salt gets wet. Carrying 10 pounds of copper to buy a horse is inconvenient. Then someone had a better idea. Standardized metal coins. Around 600 BC, the Kingdom of Lydia, in what's now Turkey, minted the first official coins. Gold and silver, stamped with the king's face. The stamp meant the king guaranteed the weight and purity. You didn't need to weigh it or bite it. You could trust it, and trust made trade faster. But here's the key detail. The king controlled the mint, which meant the king controlled the money supply. He could make more coins or fewer. He could mix in cheaper metals and pretend they were pure. And if you refused to accept his coins, well, he had an army to change your mind. This is where currency stops being neutral. The moment a government issues money, it becomes a tool of power. And governments noticed. Fast forward to the 1800s, most of the world is on the gold standard. This means every currency is backed by a fixed amount of gold. If you have $1, you can theoretically walk into a bank and exchange it for a small piece of gold. The system forces discipline. Governments can't print unlimited money because they don't have unlimited gold. It sounds stable, and for a while, it was. But here's the problem with stability. It doesn't care about human suffering. Let's say you're a country in a recession. Unemployment is rising. Factories are closing. People are desperate. Under the gold standard, you can't just print more money to hire workers or build infrastructure. You're locked in. The currency is fixed. The only way out is to wait. Or to let people starve while the gold sits in a vault, doing nothing. Britain stayed on the gold standard longer than most during the Great Depression. The result? Mass unemployment, hunger marches, political radicalization. Meanwhile, countries that abandoned gold early, like Sweden and Japan, recovered faster. They could print money, lower interest rates, and restart their economies. The gold standard prioritized the currency over the people, and eventually, people voted to break it. By 1971, even the United States gave up on gold. President Nixon announced that dollars would no longer be convertible to gold. From that moment on, every major currency in the world became fiat money. Money backed by nothing except the government's promise that it's worth something. This sounds terrifying, and in a way, it is. But it's also what gave governments flexibility. When the 2008 financial crisis hit, central banks around the world printed trillions of dollars, euros, yen, pounds. They flooded the system with cash to stop banks from collapsing. If they'd been locked to gold, they couldn't have done that. The crisis would have been worse, much worse. But here's the trade-off. When you control your own currency, you can print your way out of a crisis. But you can also print your way into one. Let's talk about inflation. The silent tax. The thing that makes your money worth less without anyone officially taking it from you. When a government prints more money, each unit of that money becomes slightly less valuable. If there are twice as many dollars chasing the same amount of goods, prices go up. Your salary stays the same, but bread costs more. You're poorer, even though nothing was stolen. This is why Germany, in 1923, became a horror story. The Weimar Republic printed so much money to pay war debts that inflation spiraled into hyperinflation. At the peak, prices doubled every 3 days. People brought wheelbarrows of cash to buy groceries. A loaf of bread cost billions of marks. Life savings became worthless overnight. Zimbabwe did the same thing in the 2000s. Venezuela in the 2010s. Argentina, multiple times. These weren't accidents. They were choices. Governments that couldn't tax enough, couldn't borrow enough, and couldn't admit they were broke. So they printed, and printed, until the currency died. Now, here's the uncomfortable part. Every government has this ability. The United States, right now, has printed more money in the last 15 years than in the previous century combined. So far, the dollar hasn't collapsed. But that's not because printing is safe. It's because the world still trusts the dollar more than it trusts anything else. That trust is not guaranteed. So why not just share a currency? Why not avoid this entire problem by pooling resources, sharing risk, and using one stable system for everyone? Europe tried this. In 1999, 19 countries adopted the euro. They gave up their francs, marks, liras, and pesetas. One currency, one central bank, one monetary policy. It was supposed to bring unity and stability. For a while, it worked. Trade became easier. Travel became simpler. Then 2008 happened. Greece was in trouble. The government had borrowed too much, spent too much, and lied about its finances. Normally, when a country faces this problem, it has two options. Option 1, print money, devalue the currency, make exports cheaper, and slowly rebuild. Option 2, default on the debt and take the pain. But Greece didn't have those options. It didn't control its own currency. The European Central Bank controlled the euro, and the ECB, wasn't going to print money just to save Greece. That would have caused inflation in Germany, France, the Netherlands, countries that hadn't overspent. So Greece was trapped. It couldn't print money, it couldn't devalue, it could only cut. Cut pensions, cut salaries, cut healthcare. Unemployment hit 27%. Youth unemployment hit 60%. Suicide rates spiked. Meanwhile, Germany lectured Greece about fiscal responsibility, which is easy to do when your economy is built on exports, and the shared currency keeps those exports cheap. This is the problem with a shared currency. It works beautifully when everyone is doing well. But when one region struggles, the currency becomes a straitjacket. And the countries that benefit from the system have no incentive to help the ones that don't. Let's zoom out. Why does the United States get to print as much money as it wants without collapsing, while Argentina prints and falls apart? The answer is demand. The world wants dollars. Oil is priced in dollars. International debt is priced in dollars. Central banks hold dollars as reserves. If you want to do business globally, you need dollars. This creates constant demand, which props up the value, even when the Federal Reserve is printing trillions. Argentina doesn't have that. Nobody outside Argentina needs pesos. So when Argentina prints, the peso collapses. There's no external demand to absorb the supply. This is the hidden hierarchy of currencies. Some are global, some are regional. Some are barely accepted in the country that issues them. And the countries with weak currencies are stuck. They can't print without destroying value. But they also can't borrow cheaply, because lenders don't trust them. So they spiral. This is why dollarization happens. Ecuador, El Salvador, and Zimbabwe all gave up on their own currencies and adopted the US dollar. Not because they wanted to, because they had no choice. Their own money had become worthless. But here's the irony. When you adopt another country's currency, you lose all control. You can't print in a crisis. You can't adjust interest rates. You're completely dependent on the decisions of a foreign central bank that doesn't care about your economy. It's stability, but it's the stability of surrender. So we come back to the original question. Why does every country insist on its own currency, even when it's risky, even when it leads to crises, even when sharing seems smarter? Because having your own currency means you control your future. You can print in emergencies. You can devalue to boost exports. You can set your own interest rates, tax your own people, and decide what your economy prioritizes. You might make mistakes. You might collapse, but at least the choice is yours. Sharing a currency means trusting someone else with that power, and history has shown, over and over, that the strong will always sacrifice the weak when it benefits them. The euro didn't save Greece. The dollar doesn't care about Ecuador, and no global currency would care about anyone except the largest economies that control it. Here's the thing nobody wants to say out loud. Money is not neutral. It never was. It's a tool of control, and every currency is a bet. A bet that your government won't destroy it. A bet that other people will still want it tomorrow. A bet that when the next crisis comes, you'll have the power to respond. Some bets are safer than others. The dollar has won for a century. The yen has survived decades. The peso has lost over and over again. But even the safest currencies are still just paper. Or now, just numbers on a screen. Backed by nothing but collective belief. And belief is fragile. So every country keeps its own money. Not because it's efficient. Not because it's fair. But because giving up that power means trusting someone else to care about your survival. And no one ever does. 180 currencies. 180 governments. All making the same calculation. That control, no matter how dangerous, is better than dependence. So we come back to the original question. Why does every country insist on its own currency, even when it's risky? Even when it leads to crises? Even when sharing seems smarter? Because having your own currency means you control your future. You can print in emergencies. You can devalue to boost exports. You can set your own interest rates, tax your own people, and decide what your economy prioritizes. You might make mistakes, you might collapse, but at least the choice is yours. Sharing a currency means trusting someone else with that power, and history has shown, over and over, that the strong will always sacrifice the weak when it benefits them. The euro didn't save Greece. The dollar doesn't care about Ecuador, and no global currency would care about anyone except the largest economies that control it. Here's the thing nobody wants to say out loud. Money is not neutral. It never was. It's a tool of control, and every currency is a bet. A bet that your government won't destroy it. A bet that other people will still want it tomorrow. A bet that when the next crisis comes, you'll have the power to respond. Some bets are safer than others. The dollar has won for a century. The yen has survived decades. The peso has lost over and over again. But even the safest currencies are still just paper. Or now, just numbers on a screen. Backed by nothing but collective belief. And belief is fragile. So every country keeps its own money. Not because it's efficient. Not because it's fair. But because giving up that power means trusting someone else to care about your survival. And no one ever does. 180 currencies. 180 governments. All making the same calculation. That control, no matter how dangerous, is better than dependence.